Joining me now in the studio is Viv Govender from Venani Private Clients and Gary Boyson. Gentlemen, tapering. That's been the discussion all morning. My colleagues on CNBC elsewhere, that's all they talked about.
Yeah.
Is this deserved? I mean, is it such a surprise?
I think that basically the Fed lived up to its word. It said it's going to be based on data, and the data very recently has been worse than expected. And that, I think, would justify holding on for a bit. They had said, we're looking to end it, but it has to be justified by, growth rates that were better, employment rates that were better, et cetera, et cetera. And we haven't had those numbers come through as strongly as the Fed would have wanted, and therefore it makes sense that they would have basically held up for now. I think what happened was the market got just too caught up in the idea that it's going to occur, and they said if they could talk about it, then it must happen. But they didn't listen to the actual details behind what the Fed was saying before.
Gary?
Yeah, it's almost as if he pulled a Mario Draghi there. So he's sort of at the end of it, he said, but I never actually said that I was going to taper the session. So it's, yeah, I mean, he did point to the letter of what he said in previous announcements, and it was very much a lot of the same. Looking at that 2% inflation target, needing to see a solid recovery on the labour market, and obviously everything being data dependent. But definitely a shock market. So, I mean, if you look at the Bloomberg consensus, I think 90% of analysts were expecting a taper. I think Viv was one of the few that said there wasn't going to be.
Do you get your bonus, eh?
So yeah, I mean, it definitely shocked markets, and you can see that it shocked markets because I mean, we're seeing dramatic gains across the board in all Asian markets and on the Dow last night.
Well, we're joined now from the Cape Town studio by Brian Cantor, who is economist and strategist at Investec Private Client Securities. Morning, Brian. You've heard what our guests have said in Johannesburg. What's your view of the great tapering or non-tapering issue?
Yes, David, I agree. It was data dependent, and the data wasn't quite good enough for Ben Bernanke to want to give up on his attempts to stimulate growth. And he's not threatened by inflation, so why not more? I think I would add that what worried him quite apparently was the move in long-term interest rates. So when he first spoke about tapering interest rates for 10-year US bond yields, order of 170 or so, they moved dramatically and quickly towards even 3%. They're now, I think, around back to 260. That was a big move, and it didn't suit him. It meant higher mortgage rates, it meant more pressure on the housing market than otherwise. So I think that was a factor in his decision really to put further pressure on long-term interest rates in the US.
Brian, Ambrose Evans Pritchard in The Telegraph, I often enjoy his pieces. He's forthright, he tends to say things in plain language, but he's got a good perspective. He talks about the American economy shedding 347,000 jobs over the past 2 months, roughly comparable with the rate of loss seen during the Great Recession. And he says it's remarkable that the Fed should even have been thinking of phasing out life support in such circumstances. If he can say that so strongly, and the rising mortgage costs and the tightening of financial conditions should slow growth, he says, why is everyone so surprised?
Well, the numbers coming out of the US are not uniformly weak. There is growth, but the growth has been revised lower. So the Fed had a forecast of growth of the order of around 2.5%, revised back towards 2%. 2.5% getting better. There was a case for removing the rate at which money was being injected into the system. I mean, 85 billion a month of extra cash, most of which, we should remember, ends up with the banks. It doesn't go anywhere. It sits in excess cash reserves of the US banking system. Tapering at some point must happen. The next opportunity might be December, again data dependent. But I think we should recognize that Mr. Bernanke is a dove. He's not a hawk, and low inflation worries him. He's concerned about inflation coming out too low rather than too high. So, as perhaps your friend in The Telegraph said, well, why not do more? Well, there's no reason not to do more if it helps.
Yep. Gary?
I think really, I mean, it was a question that was asked in the last FOMC meeting by the economist, and they really highlighted the zero-bound problem and the use of a bond buying program to try and stimulate the economy and try and generate inflation. And I mean, he did quite clearly say that he needs inflation. We need inflation to come into the US. The problem is you're using very unconventional measures. These are not tried and tested measures. And I think he reiterated that over and over again last night. He would far prefer to use the federal funds rate as a tool instead of these new measures that are largely don't have a history. I think that's what he's trying to balance off. I mean, the case for tapering might be that he's weighing up whether he should stop using unconventional measures, even though inflation maybe hasn't yet hit the 2% mark. So I think that's perhaps why analysts were starting to say, okay, maybe we are going to get a taper. Yeah, because I think in the background, because of the unconventional nature of it, you've got to be sort of nervous on what the effects are going to be. I mean, you saw it in the gold market about 2 years ago when the QE programs first came in. You saw a huge run-up in gold on the back of inflation expectations, thinking all this loose monetary policy
will produce inflation.
It's going to produce massive inflation in the markets, and that's where the speculators going. We now 4 or 5 years on, and there still is no inflation in the system. So that in itself is concerning.
There's no inflation expected. There's no inflation expected. The bond markets are pricing in between 1 and 2% inflation per annum average over the next 30 years.
Viv, Brian, I want to come back.
Interest rates.
Yeah. Carry on, Brian.
Yeah, the interest rates couldn't be lower. You can't conceive of interest rates going below zero. They're only above zero because the Fed, out of the generosity of its heart, is paying banks 0.25% per annum on their cash reserves, all of them. So, given that you can't push interest rates low, what can you do? Well, you pump in more money, hoping that money does what it usually does, which is to lead to more lending and more spending. But that really has only happened to a degree. It's still to happen.
Yeah, they keep trying to do it. Brian, I want to come back to you in a moment to say how should we think about this and its effects on emerging markets, particularly South Africa. But before that, Viv?
Yes, I mean, Brian did mention earlier that Ben Bernanke is a dove, and personalities to a certain extent always affect any human decision. And the question now arises is, now that we have Larry Summers take his hat out of the ring, we have Janet Yellen, who's in fact to the left of Bernanke, more dovish than Bernanke, in fact, according to most popular estimates. That makes us wonder, I mean, just how long will QE go on to? Because Bernanke is not going to be around, for too much longer. And when she does take over, which is the likelihood at the moment, I mean, the political support behind her is massive. I mean, we're talking about US senators actually lobbying for her. We're talking about 300 economists signed a petition, which was to get her to be the new Fed chair. So she's going to be the new person in charge. And if that's the case here, we have a person that's even more dovish than Bernanke coming to play. When will we possibly be seeing this tapering occur?
Well, Brian, what about South Africa and the Rand and our economy in the light of this?
Yeah, well, this is all very helpful to us because lower interest rates are really what we require. And I think that's pretty true across the emerging market world. The emerging markets are struggling. Lower interest rates are called for. It was hard to lower interest rates because, in fact, the Rand had weakened because interest rates in the US had risen. So it caused money flows away from emerging markets, away from emerging market currencies, putting pressure on inflation and therefore on interest rates. Now that pressure is now reversed. So we see money coming back into emerging markets, a taste for yield available in emerging markets then is encouraged. So it's all very helpful for us. The last thing we want for our economy would be higher interest rates. We want lower interest rates. And this may help to deliver them. So if we saw a bit more Rand strength, a bit more interest in emerging markets, we could see interest rates coming off. And at worst, we will stop interest rates from rising in any time soon.
Brian, thanks very much for joining us from Cape Town. That's Brian Cantor. He's economist and strategist at Investec Private Client Securities. Leaves our conversation now. But we carry on here. Something that also caught my eye in the Telegraph this morning, they're reporting on the Fitch decision, warning about China's massive credit boom. Now, everyone's talking about the US, saying that credit in China rapidly growing to unsustainable levels. And that annual new credit in China climbed to 21 trillion yuan from 19 trillion yuan in August last year. The fifth year that net new credit has exceeded more than 1/3 of GDP. Now, it's a bit of a mouthful there, but 1/3 of GDP, new credit. I mean, these are huge numbers.
Yeah, and the Chinese have a very weird credit system as well, because if you're a private, business out there, it's much more difficult than if you're a state-owned enterprise. And China being a communist country, state-owned enterprises are even larger in China than they are in South Africa. I mean, we talk about some really massive organizations out there. And what happened is after 2008, when the country basically had the stimulus program and they started to making it easier to borrow money, a lot of the state-owned enterprises took on huge amounts of debt, and in fact, some of them effectively became banks in which they borrowed money and lent it out to private, businessmen out there who could not access credit as easily.
This is the shadow banking
system, yeah. And there are huge imbalances in that system. I mean, the bad debts that have racked up because of the lack of controls around the state-owned enterprises, etc., has really done something to the economy. At the same time, there's been a bit of a housing boom in China. The Chinese economy the Chinese government is really afraid of a housing bubble, and they put in restrictions, not just credit restrictions, but other restrictions in terms of who can buy houses and pricing and selling, etc.
Well, let's pause there. And the IMF has said that the rapid rising lending has increased the risk of poor investments, poor quality. House prices in China, 8.3% up in August on an annual basis from 7% in July. The three big cities, Beijing, Shanghai and Shenzhen, 18% house prices up. So they're talking about a property bubble, Gary.
No, I mean, everyone's been talking about a property bubble in China for a long time, and you've seen the pictures of the ghost cities that have been built. And
we've talked about the highways that go nowhere.
Exactly, and I think that really is a function. I mean, it's a function of the system in China being very different from a Western system, because it's got the communist element that is the legacy. I mean, obviously they are moving towards a free market system, but while it is sort of a hybrid system between the two, you're going to have massive allocative inefficiency, and it's the point. I mean, the shadow banking system exists because the regulation is not correct. The regulation is there, and whenever you've got almost a government failure, you'll have almost a black market forming, to service the needs of the thing, exactly like what's happened in shadow banking. And now until that system moves more to a free market economy, you're going to have this allocative inefficiency. You're going to have strange property bubbles being blown up. You're going to have the government reacting and not reacting efficiently to try and curb that. And for that, you're going to have massive inefficiency, which, I mean, it creates opportunities, particularly for South Africa. Perhaps if you want to build ghost cities in your country, we're happy to supply the resources.
What the engineers always say, work is work. The engineering companies aren't going to say, no, you don't need that ghost city. They do it. 100%. They'll build it.
But the point is, the overall net wealth will not be as much as it could have been. Yeah. But yes, there definitely are people that are going to be rent seeking. There are people that are going to benefit from the decisions that are taken.
It's interesting what Brian said there. He said this is good for us, the tapering issue, but he also said, which everyone knows, that sooner or later it's going to stop. So it's rather different to the talk of that the commodity super cycle. This time it's different. It's just going to keep growing. We know that the tapering will end. It's a question of timing. So in the light of that, with the market about to open, Viv, what would you be looking for today? The JSE has hit a record as well. US markets to a record high on that tapering news, but down a bit yesterday. They're Aussie.
I mean, it's simple. Strong gold price, strong commodity prices. Resource sector is going to do very well. The rand's going to be stronger as well this morning. Even though the rand is stronger, I would still expect the market to be quite a bit higher, because we were negative yesterday on fears around tapering, and we're probably going to have a bit of a euphoric rally this morning, I would think.
Yeah, I think immediate open, definitely euphoric rally. I mean, we already saw the future was up about 500 points plus. So I think you're going to see a lot of buying. It's going to be short squeeze. I mean, they're already talking about quite a dramatic short squeeze in the Turkish market. So it looks. I think it's going to open very, very strong. I think after an hour or so, I think things are going to settle down. A little bit of volatility. We might come back there, but a lot of investors, I think, are going to reposition today. And
it's one of those days where the guys are in the starting blocks before the opening, as opposed to just seeing what happens. Well, we'll see when Tamisha comes out at the video wall a little bit later about what the market is doing. After the break, we're going to look into what's happening on that market.